You're syncing up and tuning in to the Lending Link podcast, powered by GDS Link, where the modern day lender can dive deeper into the future of data, decisioning, and credit risk solutions. Welcome to the show, everyone. I'm your host, Rich Alterman, and today we're syncing up with Kevin Moss. Kevin was my first guest on the Lending Link back in October 2022, and I'm very pleased to have him join me for my 20th Lending Link podcast. As a refresh, Kevin is a lending, payments, credit risk, and compliance management veteran, having held key roles with various companies, including Wells Fargo and with SoFi, where he was their chief risk officer. Kevin today runs his own advisory firm, providing consulting and advisory services to various companies in the lending and credit risk management space. In his spare time, Kevin sits on the advisory boards of several companies, including Plaid, Pedal, Fairplay, and fraud platform providers, including Centrelink, Secure, and NeuroID. In this episode, Kevin and I will be discussing the economy, its impact on lenders, fairness in lending, the use of cash flow data, and so much more. But before we dive into the interview, please head over to our LinkedIn and Twitter pages at GDS Link. That's GDSLINK, and hit those like and follow buttons. If you had not done so already, please subscribe to our podcast on Apple Podcasts, Spotify, wherever you prefer to listen to your podcast. All right, now let's get synced with GDS Link. Good afternoon, Kevin. I hope you have a great week so far, and thanks for returning for my 20th Lending Link podcast. Very excited to have you here today. Are you joining us from the Bay Area?
Yes, I am, Rich.
Well, good. So, Kevin, when we met in October, one of the things that you shared was that you were a big Warriors fan. I see that they had a bit of a drop in the win rate for the 22-23 season compared to the 21-22 season. If you were their coach, is there anything different you would have done to drive a better outcome?
Well, last year the Warriors had some injuries. They had Andrew Wiggins out for quite a while towards the end of the season. And they had the Draymond Green, Jordan Poole event, which I think upset the locker room, and probably the normal camaraderie that has been so well orchestrated over the last years that the Warriors have been such a great team. But Jordan Poole was traded. Draymond Green was signed to a longer-term contract. I think the picking up Chris Paul was an interesting trade, and I'm optimistic that at least for a season or two, he might bring some real value to the second team. So bottom line, last year was disappointing. It was a very frustrating season. Clay didn't play very well in the playoffs, but I'm optimistic. They picked up some height in the trades and signed a 7-foot player in a two-way contract. So I think this year will be better. Do the Warriors have what it takes? I would say I'd like to see the first 10 games of the season, and I'll tell you what I think.
Maybe you'll come back after that, and hopefully Kutch Kerr will drive home a good win for you guys. So, Kevin, it's been 10 months since we last spoke, and getting ready for today's podcast, I took the time and went back and listened to our prior podcast, and there are a handful of discussion points from our first podcast worth touching on today, in addition to some new items we had not covered. So let's get started. A key discussion item in October was the state of the economy and your view on what we would see in 2023. There's still debate as to whether or not we're in a true recession or not, but there is no doubt that consumers and even businesses are really struggling to make ends meet. Since we last spoke, there have been a lot of key events and trends in the financial markets. I'd like to spend a few minutes and just list a few here. Earlier this year, we had the collapse of Silicon Valley Bank, Signature Bank, and First Republic Bank. According to the Federal Reserve Bank in New York, household debt balances set a new record at $17.05 trillion during the first quarter of 2023, growing $148 billion or 0.9% from the fourth quarter of last year. And the debt load has spiked by an additional $2.9 trillion since the end of 2019. According to the Federal Reserve data, credit card debt has surpassed $1 trillion for the first time ever. In the past 16 months, the Fed has increased the Fed funds rate more than 5 percentage points, with 6 of those taking place since you and I last spoke in October. In August this month, Moody's downgraded 10 small to mid-sized regional banks across the U.S. and put several others on notice. And Fitch Ratings downgraded the U.S. credit rating from the top tier of AAA to AA+. And lastly, hot off the press today, just before I joined the podcast, with the federal student loan pause that took effect in 2020 coming to an end this October, A poll by the Harris poll done on behalf of Credit Karma found that some 56% of federal student loan borrowers said they will need to choose between making their monthly payments or buying necessities such as rent and groceries because they cannot afford both, according to the study. The percentage of those forced to make that choice swells to 68% for those with annual incomes of $50,000 or less. Clearly, 2023 has seen its share of challenges in the financial markets. And as we sit here today, it's hard to see a soft landing anywhere in our near future. Thinking back to when we spoke in October, which of the items I outlined above or any I did not mention are the most surprising to you? And at the same time, maybe which are the most concerning to you?
So, Rich, I think back in October, I was thinking there was a better than 50% chance that we might be in recession in the second half of this year. And I think of late, economists are more optimistic about avoiding a recession. Goldman in July put the odds at 20% in the next 12 months. Moody's phrased the term called slow session instead of recession, putting the odds over 50%. So what I see is, second quarter growth was 2.3% in the latest read on it, better than what was expected. Unemployment is still in the mid threes. Claims have been coming up, but not at a fast rate. So my view is that while much of the 6 increases that you've identified since we last talked still have to play through the economy because of a lagged effect, I think the economy's handled the Fed rate increases pretty well so far. We've seen some slippage in the stock market over the last 2-3 weeks. I think the downgrade was a surprise, but it shouldn't be. I think Fitch, what they did made sense to me. But the bottom line is bringing it back to credit and performance. I mean, we have seen significant changes in delinquency and particularly in the non-prime space. Personal loans have come back the last 4 to 6 months, where delinquency at the aggregate level has come down. The most recent vintages that we're following, which is Q4 of 22 and Q1 of 23, look better. Credit card continues to deteriorate as a asset class. Auto is softening, particularly in the used car market. And real estate's held in pretty well. Underneath it, there's a little bit of softening. So I would say that credit overall is still doing okay. And bank portfolios are better than fintech portfolios. Because what's hurt fintech volumes has been warehouse financing, rising of costs, and banks have a competitive advantage because they're using deposits to fund themselves. So what you see is you've seen a little bit of a share shift, like in personal loans, between banks and fintechs, because they can offer better rates because they're not as affected by the rate environment as warehouse financing is. So overall, I'm not tremendously pessimistic. I'm cautiously pessimistic. I think that when I talked in October, I talked about a handful of things that were driving credit deterioration. We talked about score inflation. We talked about certain credit builder trades, and obviously interest rate increases and inflation. So let's talk about each of those. So TU actually released a study, I think a summary of which was in the Wall Street Journal. And what they did is they looked at Vantage 4.0. They looked at pre-COVID, and then they took a period of time during COVID in 21. They looked at credit card performance. And what they did is they shifted the COVID performance 35 points to get the bad rates to kind of line up for most of the score ranges on top of each other. So that meant roughly that Vantage 4.0 was inflated by roughly 35 points relative to the pre-COVID.
And that was a result of the forbearance and deferments?
Correct. And the natural disaster, the way Vantage treats natural disaster trades, where they remove all the payment history. They neutralize the payment at the trade line level. So that was more than I actually thought it was. Okay. I think Vantage probably is affected a little bit more than FICO because of how they treat those natural disaster trade lines. But all scores who use credit bureau data, and payments is always a big component of most scorecards, are going to be inflated. And now, I know we'll talk about student loans later, but the next phase of this is 27 million student loans that haven't had a payment made in 3 years are going to start payments again. And the government is not reporting delinquency status for 12 months. So that's creating another potential score inflation that creditors need to think about. Okay. On the credit builder trade front, not much more to report. I still think that there are some product structures out there that are problematic. And then on inflation and interest rate increases, this week the minutes suggested that the Fed's not done. So we might see another 1 or 2 increases. And then inflation's coming down, but it's pretty sticky.
Right.
So I think we're going to be in a higher inflation rate environment for another year or 18 months. And what people don't really comprehend very easily is that even if inflation comes down to 2%, it's coming down off of a much higher level.
Right. Exactly.
So going out to eat isn't getting cheaper.
No, it's not.
It's still going to go up.
Yep.
Going to the supermarket, food is still way more expensive than it was a couple of years ago. And even if inflation comes down to 2%, it doesn't mean that prices are going to go back to where they were. So I think the impacts of both higher rates and inflation are going to have a sustainable impact on people's cash flow. And hopefully with above average wage increases for a while, maybe that could help cover some of the gap, but that's going to continue inflation at a higher level for a while. So bottom line is we still have some challenges ahead. In baseball terms, we're probably in the middle innings of this thing.
Right. Yeah, I mean, not only are groceries more expensive, but getting there here in Georgia in the last month, gas prices have gone up a quarter. And part of that's the summer, right? But people absolutely feel that in their pocketbook when they're standing there in front of that pump. And I saw an interesting illustration the other day, Kevin, I think it was on LinkedIn, where it showed 3 shopping carts and it showed what $20 bought. I don't know how many years ago, but the shopping cart was overflowing with things. And then it showed what it buys today. And there were like 6 items, in the shopping cart. And, those are, real impacts. And to your point, going out for meals. And I think people kind of rationalize that they got to spend money on food anyway. So going out for dinner is something that they're more willing to do. But yeah, price is it's pretty hard to walk away from a decent restaurant for 4 people now where you don't drop $125
or more, depending on where you live.
Exactly. So. Yeah. So thanks for the revisit on some of those things. One of the interesting things that happened earlier this year was Goldman made a decision to wind down their Marcus personal loan offering. As you think about that and think about the efforts they made in that space, are there any lessons that can be learned from what we saw with Goldman that you might want to share with the other industry people?
Well, I mean, I don't know all the inner workings of what went on from Goldman. I have a bunch of friends from there that are looking for jobs that I've been trying to help. But I think the lessons for people who are looking at organizations, Goldman has historically been an investment bank that tried to reimagine itself as a consumer, like a bank for the average person. And I think culturally, retail banking and investment banking are very, very different from each other. The second thing was that they were building this up from the ground up. They didn't really have a portfolio to start with. And anybody who's been in consumer lending for a long time knows that it's going to take a little while to cover your acquisition cost and get your policies right and your processes right. And I guess it feels to me like the company needed longer term perspective because they were losing money. And I don't know what the long-term nature of what they did. I can't talk about their credit or their marketing or anything. But the bottom line is that anybody who's looking at an organization who's new in this type of business needs to make sure that there's a real commitment and understanding about it for the long run. And that's true whether you're looking at a early stage startup and how well they're funded, or even a financial institution who wants to get into a new business. So, I think there's a lot of smart people running around that organization. They still have the Apple partnerships. They're still committed to savings. They've gotten out of personal loans. So right now they've just refocused some of those efforts. But, there's been talk of selling Green Sky and Amex wanting to step in, or someone wanting Amex to step in to take the partnership. So it could be a complete exit from what all the talk is. And for a company like that, it might be the best thing because that's not their core business. It was never their core business. So I think it's important for people who enter new businesses to really be committed for the long run on them.
Right. So that's a great segue, as we think about diversification. And, when we think about most fintech lenders, they began their life offering just unsecured personal loans. And many have expanded their products offering to include credit cards, auto equity loans, home equity loans, to name but a few. Can you share your view on the importance for lenders to become multi-product? And what are some of the considerations related to risk, operations, and compliance that they really need to account for as they, have expanded or plan to expand beyond personal loans?
Yeah, I mean, if I worked at SoFi as their CRO. SoFi started off as a student lender, and then got into personal loans and mortgage. And I think the rationale was that the Henrys, as they were called, the high income but not rich yet kind of target customer, where the student loan refinance is almost 2/3 graduate students, lots of doctors, dentists, MBAs, lawyers, $160,000, $170,000 income. The personal loan business there, they targeted larger personal loan balances than the typical prime and super prime market, higher end customers, again, the Henry type. And then mortgage, which is the single biggest credit transaction that most people do in their lives. That's as these student loan customers mature in their careers, many of them are going to end up being homeowners. So I think there was a logical flow for how SoFi expanded its lending products, and then it got into deposits and brokerage, and the whole idea is to be like a super financial app. And I think they did it a very logical way. So for a lot of these single product companies, let's say they're a personal loan lender, a bunch of them have gotten into the card space, the credit card space, unsecured, similar underwriting approaches, leveraging of machine learning and alternative data, all that kind of stuff. So it feels to me like many of these personal loan lenders are diversifying into like the card business, or some of like Prosper went into the home equity business. So I think that you just got to think about what is the adjacency of the products that you're offering. When you look at your core talent and core capabilities, how good a fit are they? And your underwriting and servicing aspects. So it does make sense to me, because over the years, like there was a time in our history where there were a lot of monoline credit card issuers. And then it was like, no, you got to be a supermarket of products, right? That was the Citicorp merger. And then I think over time, fintech has kind of reemerged with monoline companies. So I think it's a cyclical kind of thing, where I think with the internet and digital lending, if you're really good, you can be a successful monoline company. If you have great products, great experience, great delivery, great pricing, you have great analytics, which I think is the thing that really differentiates the use of the data, you can be a successful single product company, I think, in the digital world. But over time, I think growth comes from product development and product expansion too. And so looking at other products, other adjacent channels, other things that you can cross-sell or satisfy your target segment of customers with makes a lot of sense to me. Like if I love you as a personal loan customer and you have a great credit card product, I'd probably give you a shot, right? I think it all boils down to being really good at whatever you do, being really customer focused and value oriented.
Thanks for sharing that. But I mean, certainly from a risk perspective, if you were providing some guidance and working with a monoline player that is looking at, let's say, getting into credit cards, because it seems to be a typical next logical step when we look at some of the fintechs. Are there any just key words of advice from a risk management perspective that someone who's just delving into credit cards, a lot of success in personal loans, but it's a very different product?
It is.
So what are some of the nuances that they, if you were advising them, that they really need to be thinking about as they shift or expand, especially if it's not maybe with the same customer base, but it's a brand new customer base that they pick up?
Yeah. Well, hire someone who has deep credit card experience to run the business and also to run the risk for that business. Because line of credit's very different than a loan. There's lots of different dynamics around customer management, bust out, payment risk, what happens over time when people's credit starts to migrate up or down, line management, authorizations. Quite candidly, credit card is much more complex a product than a personal loan product is. In a personal loan, your key decision is, do I lend to them and how much? And then once the money's gone, it becomes a payment processing and collection game for the most part. When it comes to credit card, it's about, I tend to say that you can reduce everything that everybody does in a credit card or a line of credit business to two simple things: either focused on growing good balances or focused on reducing or controlling bad balance accumulation. And the most successful players are good at both things. Right. So you got to have a risk leader to start with and a risk team that really understands line of credit risk, transaction risk, fraud risk, all that kind of stuff. And then around the rest of the organization, you have to have people who are focused on loyalty and usage and retention and account activation and utilization programs, merchant focused things to try to spur usage where people like to transact. Like there's just so many different marketing and product aspects to a transactional product that a loan product just doesn't have to worry about.
Good advice. So before COVID hit, there was definitely a lot of talk in the fintech space where companies were considering or looking at, could they acquire a bank charter? Should they become a bank? Certainly we saw Lending Club, SoFi, where you used to work and Upgrade became banks. As we sit here today, given the current environment, do you see that as still as an opportunity for some of these fintechs to potentially become banks? Or do you think that's really been kind of put on the shelves at this point?
So first off, fintech grew up in a low interest rate environment. So the last 12, 18 months is one of the first times where we've been in a sustained higher interest rate environment. And I think, like I said, in the personal loan space, banks are taking some share and fintechs are losing it. Actually, credit unions are also doing pretty well too. And I think that banks have a real funding advantage. So if you want to be big, you want to grow to be a big lender, I think getting a banking charter makes sense. But it comes with a real commitment to compliance. You're going to have to, regulators get very concerned about very, very high and fast growth rates and things that typical fintech, early stage fintech companies are very enamored with historically. Like a bank regulator likes to see predictable growth, generally in the prime and area. Most banks are not in subprime deeply. Cap One is in subprime credit card, subprime auto, but they are known to have the best analytics for most banks. Most banks are not in subprime lending. So I think it really depends on like who your target market is, what your long-term ambitions are. I think the fintech companies like Lending Club and SoFi that have become banks have been enjoying, I think, better growth than other fintech companies have. And a part of the reason, at least, is that they've been growing deposits aggressively. And those deposits give them a competitive advantage over the other non-bank fintechs because they have more pricing spread to actually work with, right? So I do think it's an advantage. So in my view, the marriage of banking and fintech, like a Varo is still relatively small in lending, but they're growing and they're investing in it. Like, I think in the long run, a bank that has deposit funding available to it and also has the fintech platform and experience without the overhead of legacy systems and in some cases branches. I think in the long run, if that's managed well, it could be a winning model in the long run. I think what we're seeing is banks have been reducing branches as more and more adoption of the digital channel has happened. Mm-hmm. And I think that's going to continue. I don't think branches will ever go away because there'll always be people who, and branches are good acquisition tools for deposits, and people like sometimes to be dealing with people in situations, whether it's my generation or even others. But digital, remotely adaptable channels are going to be the growth engine for, I think, financial services into the future. And I think banks have a journey ahead to replace some of their core legacy platforms and become more digital and cloud-based.
Well, great, thanks. So I want to kind of bring a couple things together. We've talked about credit cards, we've talked about personal loans, we talked about coming to bank and the value of deposits. So, as I mentioned in the podcast, and you reiterated, we've seen 6 increases in the Fed's funds rate since we last spoke in October. Despite this, right, we've seen credit card debt break through the $1 trillion mark, as I mentioned. And according to a study by TransUnion, in Q1 2023, we saw a 26.3% year-over-year increase in personal loan volume to a new high of $225 billion, with the average loan per consumer being the highest on record since 2005 at $11,300 versus $9,900. Given that a large majority of unsecured personal loans are used to consolidate credit card debt, do you feel that we might see some type of a yo-yo effect with credit card balances increasing? Then they get consolidated via personal loans with the risk that cash flow pressures then result in run-ups on the credit cards that they had done the debt consolidation with. And in fact, you're probably familiar with a study that was done. It was called Winners and Losers in Marketplace Lending that came out many, many years ago that actually went through that process and showed that as people actually did pay off their credit card balances, people that had lower FICO scores tended to get a bigger bump in their scores than people that had a higher FICO score. And they found that in the study, 12 months later, a lot of people that had taken that debt consolidation and had in fact paid off their credit cards had now basically gotten to a position where now they had the installment loan and they had racked up the balances again on their credit cards.
Yep.
So were they actually better off? So do we see that phenomenon potentially happening again?
Well, there's no question that 2/3 to 3/4 of the loan purposes from my experience, for personal loans are debt consolidation or debt and loan consolidation. Most of it is credit card debt. And the reality is, from my experience, something like 1/3 of it is successful. 1/3 of it is people who kind of run back up. And then 1/3, I mean, the losses are nothing like this, but then there are people who fail completely. So a good chunk of people in the long run don't change their behaviors. Now, here's what's different today. So first off, let's talk about home equity. Mortgage cast out refi is essentially dead. Mortgage rates just hit the highest rate they have in 20 years, so over 7%. And 91% of the people from a TU study that I just saw through Q2 have rates below where the rates are right now. So home equity's been doing okay. So people are using home equity to consolidate debt. But some people are still using personal loans because they don't necessarily want to take out a second or put a lien on their home. So I still think debt consolidation in an environment where credit card rates have risen a lot, they're around 20% because most of them are variable. And as the Fed rises, so do the credit card rates. Okay. And so there's the benefit of consolidating to a fixed rate personal loan is still there where, if you pay your minimum payments, it's a 10 plus year type pay down on a credit card. But if I can take out a 4 or 5 year personal loan and I really stick to that, then I can be out of debt, when I pay off those loans. So I think there's still a strong value prop. And as the economy goes, so goes the risk associated with that down the line. So I think with higher rates and higher inflation, the risk of people running up their credit card balances again is probably higher now than it was pre-COVID. But I also think that the underwriting, like I said, the 21 and 22 vintage curves through the third quarter of 22 for personal loans were bad. Fourth quarter looks a lot better.
Right.
First quarter, it's probably too soon to read. So I think the industry, we tightened up substantially in subprime. And even on the prime side, I think people have really tightened up. So my view is that the industry underwriting's gotten more conservative, probably offsetting the risk that the environment has created. So I'm going to say that going forward, I think we're always going to see successful consolidations. We're always going to see people who run some level of debt back up, and we're always going to see people who don't successfully consolidate in any environment. You may see more or less of one or the other, but I think that underwriting is a bit more conservative now. And while people got burned in 21 and 22, I think we've now mostly addressed those gaps in performance. Now, 23 has the student loan payment resumption going on.
Yep.
And that's something that risk people should be worried about. So we got 40 million student loans out there. 27 million roughly have not made a payment over the last 3 years. And either they're making their first payments because they were supposed to over the last 3 years, or they're resuming payments that they were making before the COVID stop. And median amounts, 180, 19% over 500. So there's going to be some payment hierarchy shifts. And so, there's been some articles coming out about it. I'm working on an interesting one, which I can't really talk about, but hopefully in the next 30 to 45 days, that'll come out. And, what I can say is that payment shocks from the resumption of student loans will play through everybody's portfolio. You have that many people, a typical credit card portfolio has 20 to 25% of people who have government loans, for example.
Right.
So it's going to play through. And the other thing we have to watch out for is, since the government has made the decision not to report student loan delinquency, we're in effect creating a score inflation again. If you've got people applying to you that are their trade lines are heavily weighted with government loans, the potential score bias could be very significant, at points in the future. So I'm very concerned about, we're essentially recreating the CARES Act score biases for the right public policy reasons, but it's going to be a challenging environment again for risk people to understand how they should adjust their credit policies and their credit underwriting guidelines to make sure that we don't get another bad set of vintages from it.
That's a really good segue into my next question. And in our podcast back in October, we discussed the use of alternative data with the emphasis on data secured from an applicant's bank account. As part of this, we discussed how the use of data can help with one of the CFPB's key missions, which is the improvement in the area of financial inclusion. On July 27th, so last month, the CFPB released a new blog post putting forward the conclusion that cash flow data, broadly defined as the various inflows, outflows, and accumulated amounts in the customer's checking and savings account, may provide lenders with a better picture of a consumer's ability to repay their loans than using just a credit score. While their study validates the value of cash flow data, the conclusions, in my mind, really should not be surprising to the reader. Given your involvement with both Plaid and Prism, can you share some insights on the adoption rates of the use of bank transaction data and perhaps highlight some of the findings clients of yours have observed through its use?
So the biggest hurdle for using cash flow data is that it's permissioned. So what people like about the credit bureaus is if I have your name, address, social, and birthday, I can, unless you put a freeze on your credit file, this is friction free. Okay. So a lot of people are hesitant about, well, if I ask somebody for their banking credentials, historically, depending on the population, 50% opt out, right? Because they don't want to share their banking information. So right now, where does it make sense? It makes sense for thin or no-hit credit files, people who don't have much, if any, credit established. It makes sense for people who might have tarnished credit, but when you look at the way they're handling their primary checking account, because that's where their income comes in, they're able to pay all their bills every month and have a positive balance at the end of the cycle. So the question is, how do you find those people? So I think right now, when I talk to clients about cash flow in the consumer side, people are worried about the friction that it creates. And a lot of the discussion is about where does it make sense? Where could it be a swap-in opportunity? Where does it provide really the most added lift? Right. And I think it's in those segments. But now we got 1033, which later this year, we're going to have some guidance from the CFPB, probably effective at some point in the next couple of years. And, that essentially says that a consumer controls their deposit transaction system history with a financial institution.
And that's going to include credit card as well, right? The initial.
It may. And then the other thing is this thing called the Financial Data Exchange, which has the format by which people share the data between institutions and ultimately will tokenize the process.
Right.
So what that means is, like, if your account is at Wells Fargo and you want to apply to SoFi can get a one-time use case, without sharing credentials from your online banking to get the transaction history that they need for their purposes. Once that happens, then the potential for this to replace and complement traditional credit scores, I think goes through the roof. Like, what I can tell you is, from looking at Prism and comparing it to traditional credits, like the generic credit scores or even custom credit scores, is you can build models as powerful as you can with the credit data. But the friction is really the big hurdle.
Right.
So I think if we can get to the point where it's tokenized, where roughly theoretically could double the use of this from the abandonment we have today, I think that this in 5 years could end up as big as credit scoring. Okay?
Interesting.
But that's probably an ambitious time frame. But either way, what I'm here to tell you is the transaction data, there's really two big steps. One is taking the raw transactions, creating attributes or features, and then good data science teams can build models once they have those features. I know you guys have a set of features at GDS. Prism has them. Some other folks, Truve has them. There's other providers that have them. And so data scientists who are good at building models can get the raw ingredients to build good credit models using that data. So I don't know if it's 5 years, maybe it's longer, but ultimately, I think the best models will likely combine information from both the credit bureau, because you have things like open dates and limits and loan amounts that we don't have in the deposit account.
Right.
And you can combine that with things from the deposit account. And I think the models that you build will be stronger than the models you could build individually with either transaction data or just credit bureau data.
And like you say, GDS has done that. We've built hybrid models, taking in both, the credit bureau data and the banking data. So it's definitely a powerful lift. So I'm keeping an eye on our time here. I'm going to wrap up with one last question. So back in December, when I did a podcast with Kareem Saleh, who's the CEO of Fairplay, and Fairplay offers a fairness as a service platform, which helps lenders identify potential biases in their decisioning systems and provides options to increase profitability and fairness. And one of the things that, we talked about when I was speaking to Kareem was how potentially there's some lenders that really may struggle with their decision to leverage a platform like Fairplay, perhaps adopting a little bit of a head in the sand approach, recognizing that you're an advisor to Fairplay and putting on your unbiased consulting hat. What guidance would you provide lenders you consult on the value of adopting a more proactive approach toward disparate impact and disparate treatment identification?
So we could spend an entire hour on this, but here's the message that I would share. The world that we're in today is migrating towards the use of more advanced modeling techniques. And what comes with machine learning and AI is a higher bar around things like fairness, making sure that models are explainable, that we can provide adverse action reasons, all the things that have been well ingrained for 50 plus years in like logistic regression models. So to me, if you want to play in more advanced model techniques, which over logistic regression probably lift between 15 and 25% the separation, whether it's AUC or KS or whatever your metrics of choice. The advanced modeling techniques which handle interaction effects more effectively, particularly with transaction data, it provides substantial lift. So the business justification is you can approve more loans. We can make more loans to people using especially the alternative data to people who are underbanked or unbanked at fairer prices instead of going to payday lenders or paying, triple digit loan rates. Many of these people hopefully can qualify for under 36% lending. But part of what model governance and model fairness advocates have to accept is that there's a higher bar for validation. And so what I sat in on Kareem's pitch to NICA, and I hit it off with them because I believe that the future is here today, that the opportunity to use some of these advanced techniques is there for banks. Cap One's been using it. Others have been using them for many years now. But it requires you to, Patrice Ficklin from the CFPB basically said, if you're going to use these techniques, you better be using fair lending evaluations very carefully. And so what I think is that, like, the traditional way of doing fair lending analysis was, it's time for me to do an annual fair lending test. Your lawyer sends a request. You go to a Charles River. Maybe you have a big bank has their own teams. You find some differences. Maybe you do a match pair test. You say, oh, it's all explainable. Somebody writes a memo. It goes into a locked drawer somewhere. Okay. And, and then you deal with it when the regulators come and do their fair lending testing. I think that's an old model. The new model that we have available to us is with Fair Play, you can do continuous monitoring. So you can know every day, theoretically, what you did, whether a group of loan applicants that had the wrong pricing, did someone get approved or denied at the wrong rate? And you can correct that virtually in real time. So what I think is that for companies that want to be completely open and fair to all protected classes, to all of their customers, Fair Play offers the opportunity for you to do continuous monitoring, continuous remediation if there's anything that has to be addressed. And then you could frankly share that publicly, which will give lawyers agita and class action attorneys will want to go after that. But what a marketing advantage that a firm could have to say, XYZ Bank, we're the fairest you could be. We're going to share with you what we've seen and what we've done about it. So literally, I had 50 loans last month that I lowered their rates 25 basis points because our monitoring identified that there was this little pricing disparity. It's taken care of. We've already lowered the payments for the customers before they even made a payment. I just think the opportunity for a financial institution to differentiate themselves rather than lock this thing up in a drawer and not talk about it, I think represents, like, who wouldn't want to work with a company who is completely open about the fairness that they bring to the table? So I think this is a huge opportunity for the industry to reduce the impression that so many people in protected classes may have that we discriminate against.
Right. Yeah, one of the things that Kareem and I talked about was the goal, the vision, right, of having like the United Laboratories stamp of approval with Fair Play, right? That this is my certification. So Kevin, we've come up on the top of the hour. I want to take this opportunity to thank you for joining me today on my 20th podcast. It was great to have you as my first guest and great to have you as my 20th guest. This is Rich Alterman. We've been syncing up with Kevin Moss, a 40-year veteran in the lending, risk management, fintech, and banking areas, who is proudly wearing his Warriors shirt. Once again, thank you, Kevin. And no one can see that, but he's proudly displaying it. We hope you've enjoyed this podcast, and please stay connected with GDS Link and the Lending Link to listen to future podcasts and catch up on the ones you've missed. That's a wrap, and make it a great day.
Thank you.
Thanks for listening. If you've enjoyed today's episode, please be sure to subscribe on Apple, Spotify, Google, or wherever you listen to your podcasts. And be sure to leave us a review. Follow us on LinkedIn and connect with us on Twitter at GDS Link. That's at GDSLINK. Have a question for the show or have a specific topic you want us to cover? Hit the link in the description to drop us a note. Thank you for lending us part of your day. Make it a great one.